Good morning. Today is Wednesday, March 13th, and this is another edition of the Market Commentators, a podcast brought to you by the Milwaukee Company. My name is Matt Salm. I'm an investment analyst with the Milwaukee Company, and joining me this morning is Andy Wilms, President and CEO of the Milwaukee Company, and Mike Wilms, Andy's cousin, who serves on our wealth management and portfolio strategy teams. A reminder that nothing in this podcast is meant to constitute investment advice. But we have a full-blown legal disclaimer at the end of the episode. So with that, Andy and Mike, good morning.
Good morning, Matt. Good morning, Andy.
Good morning, Matt. Good morning, Mike. How are you guys?
Fabulous.
Yeah, doing quite well.
That's wonderful. I'm glad to hear it. Glad to hear it.
You're starting out kind of grumpy this morning, Andy. I'm just
I
trying
am.
to
I am.
a little levity
know
here.
that, but okay. I'll try and lighten it up.
Well, do you want to start us off as per usual with a recap of what's happened in the market, Andy?
Sure. Well, if we start with just a summary of what happened last week, the market once again proved that it is forward-looking, with the S&P being up 3.5% from last week, and closed the week up more than 31% from the lows back on March 23rd. Stocks fell sharply yesterday, giving back some of their recent small gains. Basically, at the close, there was a variety of speculation why that would be. University of California's college system announced at the end of the day that it was going to be online learning for the first semester. Los Angeles extended its clampdown. I mean, there were a number of different factors that might have contributed to yesterday afternoon sell-off. But it really seems to me that there's sort of a battle being waged here on a daily basis with the people who are optimistic about what's happening with the COVID-19 medical advances and the reopening of the economy, and those who are pessimistic about the ability to develop these medicines needed to contain the virus, the risk of a second surge of as a result of infections, as a result of trying to restart the economy too quickly. So it's almost like trench warfare of World War I. Everybody, one side gets a few feet, and then the next side gets back the other few feet, and a lot of carnage is being done, but not much ground is being taken one way or the other. There's just a great deal of uncertainty. The one thing you can say amidst all this uncertainty is that, the big tech has been definitely the top performer during this coronavirus. This past Thursday, NASDAQ entered into positive territory year to date, which is just, rather shocking if you think about it, that they're up, that NASDAQ is up for the year, but it's the only major index to do that. And just to prove that even the big tech names are not immune from what's happening in the economy, Netflix and Alphabet, which is Google basically, were all down 1% yesterday. And Netflix and Alphabet were down 2% yesterday, and Facebook, Amazon, and Apple were all down about 1%. So, and then you had Stan Druckenmiller, which most people in the investment world know as one of the very highly regarded market commentator and fund manager. He came out with a statement that the risk and rewards in stocks is the worst he's ever seen, while calling the prospect of a V-shaped recovery fantasy. And picking up on that sort of negative tone, Federal Reserve Chairman, Powell gave a press conference actually it was still going when I tuned on for the podcast, indicating that he thinks that, and I'll quote him, the length of the recession can leave behind lasting damage to the economy's productivity. So basically saying that the Fed sees the odds of a V-shaped recovery at this point being very small as well. He also commented that the Fed was not considering going negative on interest rates anytime soon. So today, this morning, the futures, I'm recording this at 9 o'clock or 9:30, I should say, almost at this point, and the future, and the market has opened lower. What the future holds from here is anybody's guess.
Yeah. No question, there's a great deal of uncertainty. But one of the kind of interesting statistics, going back to your comments about the big tech names, with Amazon and Google, Microsoft, the top 5 tech names in the S&P 500 are now 21% of the average. And to your point, the fact that the NASDAQ is up, NASDAQ would include those 5 stocks. It would be an interesting calculation to see where the S&P would be on the year if those 5 stocks weren't in the market cap weighted index.
Well, since Matt's our in-house mathematician, maybe he can get us that information.
No, we certainly could. I agree it'd be an interesting thing to look at, just because those stocks have done well while a lot of the economy has taken a beating.
I don't think there's ever been a time in history where 21% of the S&P has been concentrated in just 5 stocks.
It just goes to show how much difference there is between the haves and the have-nots in this economy. Anybody who could benefit from people staying at home, which is obviously a lot of these tech names we're talking about, has done extremely well. Some of the pharmaceutical companies have done extremely well, and everybody else is really struggling at this point. So,
well, and I did read the press coverage of Stan Druckenmiller's speech yesterday, and he is very bullish on Amazon, and he commented that he actually gets emotionally upset when people attack the company, given the benefits it's providing to the overall economy.
Yeah, well,
I can't say I've ever, well, I mean, it's not, I've never cried about a stock that's been going up.
I can agree with you on that one. Matt, why don't you tell us a little bit about we're talking about what's going on with the markets, and that's being driven in large measure by what's going on with the outlook for the COVID-19 treatments. Can you update us on that a little bit?
Yeah, so research on the coronavirus continues to be published at a furious pace by researchers all over the world. A few studies this week that I thought were interesting, and that Andy thought were interesting as well, came out of the New York area, which is a great place if you're doing research on this topic because there's so much data related to COVID-19. There was one study with just over 1,300 people who found that nearly everyone who has had the coronavirus, even if they only had mild symptoms, had produced antibodies to a sufficient level that it may confer future protection against the disease. Scientists don't yet know for certain whether the antibodies will confer immunity, but it was, I think, an important finding in that direction.
It brings some hope to the plasma treatment, which is very, where they take the plasma for people with the antibodies in it and give it to the people who are ill or as a precaution, and to people who aren't, and it creates, optimism in that regard too. And some of those studies have been quite positive. But again, how do you get enough? It's hard to find enough of the plasma to treat everybody.
Well, and understanding how much plasma would be effective to confer immunity and so on and so forth. But I mean, this is all around the goal of herd immunity. And, what's really key is once an individual has generated the antibodies, the medical community needs to understand how long the immunity and the antibodies remain in one's system. Is it 1 year? Is it 3 years? Because that's where the benefit of bending the infection rate down and getting this under control really is going to come into play.
That's exactly right. Yep.
Agreed. Another study out of the New York area, again with a little over 1,300 people, was a bit less optimistic. This one was focusing on hydroxychloroquine. And it found that people who were given the drug as compared to people who weren't given it actually got more sick on average. Granted, this was not a randomized trial that was conducted, so more scientifically rigorous trials still need to be done. But this is certainly a bit of a blow to hydroxychloroquine.
Another positive factor we should keep in mind is there's still reason to believe that this is a seasonal type of illness like the flu, right? We don't know that to be the case, but there seems to be evidence of that. And as a result, we might be seeing, some of the cases coming down, even with the reopening of some sectors of like Florida, for example. They've begun to reopen, and they haven't seen the spike yet that people were expecting that would come from it. And it could very well be that there is a seasonal component of this. Is experience in Brazil sort of bears that out too, right? That might be a cause for some optimism and buy us some time. If there is in fact a seasonal component to it, that would buy us time to do the things that we could still reopen the economies very carefully, albeit, and over the course of the summer, and by the fall, use the summer months to increase the supply of equipment needed, face masks, hand sanitizer, treatments, all those things, so that by the time the seasonality benefit wears off with the changing of the season, we'll be better equipped to deal with it. I think that's a big positive potentially.
I couldn't agree more. The magnitude of the resources that have been allocated to treatment in the short term here, and having a window between spring and fall, if there's a seasonality attached to the virus, would be a huge advantage.
It may well be that reopening, if we were at the same stage in January as we are now in terms of the number of cases and all that sort of thing, reopening the economy, as some states have begun doing, could prove to be much more problematic than if you do it in June, right? I mean, it's just because of the seasonality component of it. And I think, like in Wisconsin now, this morning, they announced that Wisconsin had met 5 of the 6 criteria to begin reopening the economy, and that the one that it hadn't met this last time around was met previously. But there's no consideration of the seasonality component of this in making the decision. The official program doesn't factor that in at all, right? It's not a consideration that the state of Wisconsin is giving weight to when determining whether or not to reopen the economy. And I think that could prove to be mistaken, but I understand the reason for caution too, because we don't know that there is a seasonality component, so you can't bet the farm on it that there is. I get that too. One
last update that I thought was worth sharing was a study out of Hong Kong that actually found that a 3-drug cocktail was more effective in treating patients with mild and moderate symptoms than only a 2-drug combination. It's not uncommon with other illnesses that we fight them with a multi-drug cocktail. And so it makes sense that could be effective for COVID-19 as well.
Exactly. I mean, if you look at AIDS, which is viral also, AIDS is treated with a 3-drug cocktail also.
Shall we move on then to the macroeconomic side of things and talk a bit more about markets?
Let's do that.
Mike, do you want to lead us off with a recap of some important stuff coming out of the Labor Department?
Well, the most eye-opening number, I guess, I don't want to use any kind of inflammatory kind of references, but the Bureau of Labor Statistics numbers on Friday for the employment report were pretty eye-opening, with a loss of 20.5 million jobs in the month of April. Unemployment rate soared to 14.7%, which is the highest rate since the Great Depression, and the level of people on unemployment has now exceeded 30 million, and it continues to grow here as the economic impact of the shutdowns are still manifesting themselves pretty much across the country. We saw some food price surges in April, and that's partially offset by drop in energy prices. I mean, we've all seen the drop in the cost of gas at the pump. I mean, I think, Andy, I texted you a picture of gas at 99 cents a gallon. The consumer price index actually fell by 0.4%, which was the largest monthly dip going back to 1957. So there's a lot of extreme developments in the economic statistics. And through it all, the government bond market has been fairly flat. I mean, the 10-year Treasury has fluctuated up a couple basis points, down a couple basis points, but yesterday was the first day that the Federal Reserve implemented their purchases of corporate bonds. The market had been eagerly awaiting them getting the program launched. Yesterday was the first day that they purchased ETFs, and they also are in a position to buy secondary, meaning corporate bonds that have been outstanding for some period of time. Secondary issue corporates with a focus on the companies that might have been investment grade prior to the coronavirus impact, that were subject to a downgrade and are no longer investment grade. They've fallen into junk territory, the quote unquote fallen angels. They're the backstops that the Fed has contemplated are all pretty much in place now, and some semblance of normality is returning to the fixed income markets.
Andy, did you have anything to add on this front?
No, I don't think so.
Okay. In that case, I guess we'll move on to the more portfolio management section of the show, where we try to tie these topics back to the individual investor and things that they might care about for how they're managing their own portfolio. So in last week's podcast, we talked a little bit about maybe this being a good time to take some risk off the table because the market has rallied so significantly since its lows in late March. Andy, do you still think that that's a good idea for some people, that they could maybe reduce their allocations to stocks and increase allocations to short-term treasuries or highly rated munis?
I do. I think that's true for those investors who may have lost confidence in their portfolio when the markets bottomed this past March. If you're beginning to lose sleep over where you were at back in March, then I think it's a good time to maybe take some risk off the table, because I think there's a distinct possibility that we could retest those lows in the months ahead, or even surpass them before this whole episode is behind us.
And if we might retest those lows, do you have any thoughts on why the market has rallied so much to date?
Well, I think there's several reasons for that. Perhaps one of the greatest ones is that the market tends to be forward-looking, right? So if investors as a group think that business conditions will be better 6 months from now than they are now, they will buy stocks on the belief that those companies that they're buying stocks in will be better off 6 months from now, when conditions improve. And it's important to recognize that for most part, Mr. Market, the market as a whole, which we refer to as Mr. Market, his predictions have been more accurate than those of any one individual historically.
Yeah, that makes sense. So would you say, though, that this time around you have faith in Mr. Market's predictions?
Well, I would say that in general, I think Mr. Market's more, if you pick any moment in time and you say that Mr. Market's predicting one thing and any one individual is predicting another, if you had to make that bet, the odds would be probably that Mr. Market is going to be right more times than he's wrong. Okay. But I think this, so that's not why I'm telling people to lighten up on equities if they were concerned last March. What I'm suggesting to you is that because of this increased uncertainty surrounding the coronavirus, and its impact on the economy, it increases the risk of the Mr. Market being wrong, but also increases the amount of risk in your portfolio. So if you are targeting a certain level of risk, and that was represented by 50% in equities and 50% in bonds, right? But market uncertain, there's all this uncertainty that pushes the risk element of owning equities higher. You're no longer at risk parity at 50% stocks and 50% bonds. You might have to go to 35% stocks and 65% bonds to get risk paired to your personal risk tolerance. So, and in that case, it may make sense to say here where the market, with this uncertainty being present, we're going to make a tactical decision to temporarily reduce the amount we have in equities.
Well, and I think what ties in with some of those thoughts, Andy, or some of the Wall Street prognosticators are calling for a dip in between now and the third quarter based on where the market has rallied to here off the lows, and recognizing all of the uncertainties that don't seem to be properly priced in the market right now. I mean, there's a huge amount of just look at the number of question marks we've discussed in this podcast in just a short period of time. And, the question is, are all those uncertainties properly reflected in the equity market? And, as an individual investor, you need to, as you had mentioned, continually benchmark your own comfort level with the risk that you're taking as it relates to equities and bonds.
Right. Now, but let me also say, I think you got to be very careful when you start going down this road, right? Because you don't want to get yourself in a position that every time you think market risk is elevated, you're going to cut back on stocks. That's just market timing, right? I mean, and we've all talked about the problems with market timing. So in my mind, you have to be extremely judicious when you do something like this. It has to be under a set of circumstances that is very extreme, where there is a risk of a dramatic development that you weren't anticipating when you decided on how you were going to allocate your portfolio between stocks and bonds. And I think this is one of those very rare occasions where it makes sense to adjust, lower your allocation into stocks. And I can go back to, the last time we had something remotely similar to this was 2007, 2008. Mike and I were working together on some portfolio management then, and we did not advocate that our clients reduce their allocation to equities at that time, right, Mike? I mean, we said, in fact, it bumped it up a little bit just because of the tactical asset allocation methodologies that we used, the algorithms that we used kind of called for that. So even in something in that severe, I wasn't advocating for reducing stocks, and I'm glad I didn't, right? Because the stock market ended up coming back with a vengeance. This situation is different than that, different than anything else we've ever seen. And I'm hoping the stock market rallies like crazy. I'm hoping that the decision to take risk off the table for certain investors proves to be the wrong one from a portfolio performance standpoint, because that means everything else is going great, for that to be the case. And so giving up a couple of percentage points on the upside is a small price to pay for that outcome.
And the point I would make is you're talking about that time frame, 2007, 2008, and it took that long for the market to climb. We were not talking about 30 days like we are in this.
That's a very good point. Yep.
And so that's
march down, so your portfolio could adapt to it as it was going forward. And just as we shot down, we have the sudden shoot up, which may introduce more risk for certain investors. Those who have a very long time horizon, if you're saying, listen, I'm not pulling anything out for the next 10 years or even 5 years or more, let's say, and I don't watch my portfolio every day, and if the market goes down 35% from here, I'll still be okay. I'll still be able to sleep at night. For those investors, I'm not suggesting that they need to take more risk off the table. For the people who don't fall in that category, that might need to withdraw money for personal expenses or may not be able to sleep well at night if we retest the lows or go lower than that. Those are the individuals I think could be well served. If you're or if you're in an asset preservation mode versus asset creation, right? Someone your age, Matt, who's in asset wealth creation phase, can say, what do I care what the stock market does tomorrow or 5 years, next 6 months, a year, 2 years? I don't care. I'm going to be saving money. I want it to. You should want it to go down, not you personally, but young people benefit from a drop in the stock market tremendously, right? Because they're able to buy at low prices.
Exactly.
So this is a great buying opportunity. If the market goes lower, it's just the opposite for a young investor. They should be loading up, buying on sale when you can. You know what I mean? Even because they have so long to use. But if you're an older investor who's going to be starting to spend principal, we've had a little rally in the market. Maybe now's a good time to thread back on risk a little.
Yeah, that makes sense. It's all tied to your individual risk tolerance and investment horizon, as we've talked about before. Right. And then something else we've talked about is that the best portfolio isn't necessarily the one that gets the highest returns, right? You have some thoughts on that, Andy. What is the best portfolio?
Well, it's really the one you could, I mean, this is an old cliche, but the best portfolio in many cases is the one that you should keep, that you can keep in, you can stick with, I think, under all but the most extreme conditions, you should be able to stick with your portfolio. And we use, as you know, Matt and Mike, our philosophy has been to use rules-based tactical asset allocation strategies that can be tested and that you can have confidence in because you've run thousands and thousands of simulations to see what might happen with the strategy under a whole host of situations. And you can be comfortable with the outcome in those back tests or those simulations. So that to me is the way you build the confidence in a strategy. And it might not be is it going to be the highest returning strategy? No, I mean, what the top strategy is, put 100% in the top performing stock in the stock market, right? No diversification, concentrate in the top, in just the FANG stocks. That's been the best strategy for the last several years, right? But is that the best strategy? I would argue, except for the very few, it isn't.
Well, it's the best strategy right up until it's not.
Right. Yeah, that's right. And if you for the vast majority of investors, it's not, because it has a lot of specific risk associated with it, and you just can't. It's difficult when you put all your eggs in one basket like that.
So, in addition to risks posing, I guess, individual stocks in a concentrated portfolio, there's also risks people have been talking about related to a drawn-out bear market this time around. I know we obviously don't have a crystal ball, but Andy, do you want to share your thoughts on the potential for a long, drawn-out bear market and why that may or may not be the case?
Well, typically bear markets do last a relatively long time. You talk in terms of years for a bear market, not months or weeks or months. But I realize too that one of probably the most dangerous expression in investing is "this time is different." Right? But it's easy to see why people think this time might in fact be different. I acknowledge that. The stock market fell 20% in 16 days, like Mike pointed out, and you follow that up. That was in February, and then you follow that up with April, where it was the best market. The stock market has best performance since 1987, and but even then, the stock market has a ways to go to get back to where it was. And whether the current bull market is sustainable is really unclear. Even in the best of times, market predictions are made at your own peril. And the fact that here it's even more difficult to make predictions because we have virtually no historical examples that we can look back at for precedent. So it's really, really difficult, and for the reasons we've talked about today and in prior podcasts, I just think that for many of our investors, our clients, the current bull market should probably be regarded with suspicion, and I would continue to have that, have my doubts. I'll be the doubting Thomas, I guess, until there's both an effective treatment and a vaccine. that's ready to go for COVID-19 until we had social distancing requirements largely lifted throughout the continental United States. And there appears to be positive trends in the economy. Durable good orders increasing, jobless claims decreasing, and we start to see some significant improvement in consumer and business confidence. It would take a combination of those three things where I think you could really say, okay, we have some clarity as to how this is going to play out and could make investment decisions accordingly.
Yeah.
Well, I think one of the there are a couple of things to recognize with the start of previous or the most recent bear markets. Even going back to 2007, the Federal Reserve was raising interest rates, and most bear markets are predicated by a rising interest rate environment. Obviously, we don't have that. And then the second potential mitigating factor relative to a bear market would be the massive federal stimulus with the CARES Act at 2.2 trillion already. So my crystal ball is no better than anybody else's, but there are things that are different in this current environment versus some of the more recent bear markets.
And the question becomes, over the short term, I think people are pretty much in uniform that the government intervention by both the Congress and the Fed have been positive. The long-term ramifications of that intervention, and now we're talking, another $3 trillion of stimulus money being printed and pushed into the economy, bringing the total up to somewhere like $8 trillion. What the long-term ramifications of that will be for the economy is much less clear.
Well, that could be the podcast topic for next week. How's that?
There you go.
And because that is a very important and long discussion.
Yeah, absolutely. And I was going to say to our listeners, if they have any ideas for podcast topics they'd like us to talk about, please reach out either to firm@milwaukeecompany.com or get a hold of us via any other channel that you would normally use. You can find us on Twitter @TheMilwaukeeCo. And you should also subscribe to our newsletter if you're enjoying these conversations. I'm going to have a column on the newsletter now directed more towards young investors. Andy has his column, and a few other people at the Milwaukee Company are writing for the newsletter as well. So you get some more of our perspectives. You get perspective of more people at the firm. And it's just a nice, succinct weekly newsletter straight to your inbox. Yeah. Well, yeah, thank you both for joining this morning, and I look forward to talking to you again next week.
All right. Thank you, Matt. Bye-bye.
See you guys. Thank you.
Bye. This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.